Okay, everyone. Today we're going to talk about disability insurance. This is again a really important part in CFP exam. So it has multiple learning objectives. So what is disability? Disability is part of life. Okay, around 10% of the population live with disability. American 1 in 5 live with disability. And then those are the numbers, right? As people age, right, the likelihood of disability increase significantly. So that's the main reason why we need a disability insurance. So what is the issue with disability? It means you can no longer work, okay? And then if you can no longer work, remember we are trying to hedge, right? Income risk. So that's a lot of most retail finance is trying to hedge income risk. That's all about it. And then let's have some numbers and give you guys some idea of the disability versus death. We talk about life insurance, right? So we all know why death can be very bad financially for the family. And also, if you think about disability, this is even worse. If you look at the ratio likelihood, okay, 4 times, right? Like I'm around age 30, so that's like 4 times to death. That's the ratio. So if you want to think about risk management, this is probably a larger risk to manage. Certainly the government, the US government, has something in place, right? It's called Social Security or workers' compensation if you get injured during your work, right? You have some worker compensation if you get disabled. Social Security will provide some benefits, but they have some rules, okay? You need to meet certain rules, and then you need to work enough hours or like credits. We'll talk about Social Security toward the end of this semester, okay? Employer, this is the main focus, okay? A lot of times I take myself for example, right? I have disability insurance with employers. So we have short-term disability and long-term disability. It's pretty straightforward, right? Short-term disability means you will pay some money if you are disabled, like for 1 or 2 years, right? Long-term is like if you have a long-term condition that can prevent you from work, right? That's a long-term. This is a larger risk. Short-term disability is potentially good, but a lot of times maybe you can work around it. But long-term is a larger risk. This is a larger risk we have. You can get through your employer. A lot of employer offer that. Winthrop offer that. You can also buy your own policies through an independent insurance agent. So the point is it provides income to the injured in the event the insured is unable to work because of illness or injury, right? So those are some considerations. It can be for sickness or accident. 1/3 of disability occur because of accident, 2/3 because of sickness. You need to think about the amount of coverage. You need to think about how long, right? A lot of them will pay. You can choose until age 65. Why we stop at age 65? Because this is when you retire. So think about life insurance, disability insurance, all those, right? Or think about your own earning power, right? After you retire, you don't make any money, so it's not necessary to protect after that. Or you can choose a lifetime. So you have a longer term, it's more expensive, okay? Or you get less, right? If you have longer term. So they have some definition of disability, and then they have elimination periods, and then some tax considerations. In general, 60 to 70% of your income, okay, that's the amount you should choose. Why don't you choose 100%? Because remember, right now you have 100%, right? However, some of them will go to the gas, right? You need to drive to work every day, and then it has very high tax rates, right? And then Social Security, right? And then FICO. All those kicks in, right? So if you get 70%, very likely you get as much money as if you work 100% of salary. Is that making sense? So let me know if not. This slide is not necessarily done right. Let me edit it because I don't want to distract anyone from reading it. So this is the way it should look like. Okay. I don't know why the layout is really weird. So short term 0 to 2 years, and then we have long term. I don't like. Don't worry about this. Or even don't worry about it. 5 year, I wouldn't consider it long term. I don't know why it's here. those are not long term. Okay, if they say it's long term, don't buy it. Don't buy a long term disability insurance with only 5-year coverage. What are you gonna do after year 5? Okay. Maybe like year 5, I can find something else to do. Okay, we're gonna talk about how you qualify for disability. Okay. Ideally, this. Okay. This is very idea theoretically. Definition. Okay. So in order for them to pay you disability income, you have to meet the definition of disability. Own occupation. What does that mean? You'll be considered disabled if you or insured cannot, or your client, right, cannot perform the duty of his own occupation. So basically, if your client is a medical doctor, right, if he cannot work as a doctor anymore, and then it's qualified as disabled. So if you choose, okay, those are the choices you have, options. So you need to pay attention to this. Okay, some of them don't have this. Ideally, you should have this. It's more expensive, but it is very ideal for our clients, especially. Like, think about who's going to work with financial advisors, right? They make good amount of money, so own occupation will probably be better off. Wait a minute, what's the second definition? It's called any occupation. What does that mean? Okay, consider disabled if insured cannot perform any, any occupation. So that means they're gonna, for which educate, experience, or train. So they can train you to work well. Like if you have a client who is a medical doctor and then kind of have any occupation, right? What's that called? If you guys pay attention to Avengers, there's a guy called Doctor Strange, right? He was doing surgery, he get a lot of money, and then later he got into a car accident, his hand is shaking. And then if that guy is your client, and then you have any occupation policy for him, and then the insurance company will train your client to work in McDonald's. Okay, that's bad, right? So you don't want that to happen. Okay, so don't bother with this. However, this can be good for some people, right? If they are not that specialized. Certainly, they have split definition. Again, everything is a legal contract. You can define like the first 5 years on occupation and then any occupation. So that's another choice. Most of our clients, go with this. We have residual benefit if your client can go back to work, right? However, because of some disability, your client can work like somehow. However, he cannot work 100%. So with a lower pay, then the insurance company will cover the gap, right? So this is original pay, right? And then your client can only get this much because he cannot perform some other job, and then the insurance company will cover residual benefit. This is where residual benefit comes. Okay. You can also add a rider. A lot of insurance products you can add additional. It's like when you buy a car, you can always add more and more options, right? So this is a rider. So you can, with the rider, you can make sure the future benefit increase stay together with inflation. Okay. So that's the mainly thing. Okay. So you can say like right now you have like maybe $2,000 every month benefit, and then 10 years later $2,000 might be not enough because of inflation. That's when you want to add a cost of living rider on it. Okay. And a lot of disability insurance are through employers, which is group. Okay. They do have short-term and long-term. Actually, they're Winthrop. I don't have the short-term. I choose to get a long-term. Advantage is the premium. Okay, this is before tax. Okay, first of all, an auto employer can help you cover a little bit. Employer may pay for the premium, okay, or may permit employer to pay directly from payroll deduction. That's what I did, from payroll deduction. If the insured pay the premium with after-tax dollars, and then the benefit received will be not subject to income tax. Again, if your money is taxed, and then you use the money to buy the product, any income from this will not be subject to tax. They don't tax you twice. Okay. However, if the policy is paid with the pre-tax dollars, or if you like do payroll deduction automatically, and then you will subject to income tax. That's fair, right? Elimination period, they do have elimination. Present amount of time your client have to be disabled to begin receive payment. So the elimination period represents deductible. So yeah, it's days, how many days, right? I don't remember exactly. When we go to Social Security, we will talk about it, because ideally you want Social Security to work somehow with your insurance plan so that they don't have a gap. Oh, right here, okay. Integrated with Social Security, okay. Disability payments from the insurance company are reduced by the amount paid by Social Security. Waiver premium, if your client is disabled, the premium can be waived. For the policy's life following a specific elimination period, it is elimination period as short or not necessary the premium coverage. Okay. So this is pretty much everything you need to know for this part of the class. That's all. Thank you all.